For those of you that have been thinking about this open banking phenomenon, one of the things that is most important, I think particularly here in North America, is a new organization that really has open banking as its mission. And you have an opportunity to hear about the Financial Data Exchange from Don Cardinal, its managing director. So I think that this really kind of builds on the previous presentation, which was more technical. Don's going to be able to give you some contextual business and legislative context for how open banking will be shaped in the US and how the US will shape open banking on a global basis. Don?
Well, good afternoon, everybody. As Don mentioned, I'm not quite the last thing between you and drinks, so that's always a good thing, not to back clean up. This is not a technical presentation. This is instead to tell you who we are, what our mission is, and more importantly, how to arm you to talk to your executives, your business leaders about open banking, data sharing, and why they should care, what's in it for them. So we'll hit forward. I do have a presentation at some point. There we go. So the Financial Data Exchange came into being in October of last year. It is a consortium of all the people in the ecosystem. We have banks, fintechs, aggregators, permission parties, and that sort of thing. So let's get into it. I love this graphic because it really is important to talk about who we are, how we view things. We see the customer sitting in the middle, right? The customer is king. They're in charge of everything. They're directing where things go. They're permissioning their data. They're seeing it's transparent. Whether they use an aggregator or they're doing it themselves, this really encapsulates customer first. And of course, we are unifying the financial industry around a common, interoperable, royalty-free standard for customer and business data sharing in a secure manner. It's open banking, but it's little o little b, putting the customer in control. And this deck will be available afterwards as well. So who the heck are we, right? We're a not-for-profit. We're a 501c6. We're part of FSISAC. We have some of the largest names in finance and technology as our members. So you can see we have the big banks, the credit unions, MasterCard, Visa, core processors, all the large aggregators in the US. And we're currently balanced very cleanly between permission parties, aggregators, industry groups. We realized that we needed everybody in the ecosystem, whether you are an app provider, an aggregator, or a data source. End to end, you had to represent it in the data system. But we have open membership. Anyone can join. Our dues structures are similar for any size can join. It's very affordable. So what is it we have, right? What's the product? Well, our framework is primarily the FDX API, and you may know it as a Durable Data API or DDA. Again, it's secure authentication standards, tokenized access to data, no more held away credentials. We polled FIs last year in North America and said, how many of your customers have given up the goods, given up the credentials? And the back of the envelope math, mind you, there's a little double counting, but we got to 35 to 40 million really, really quickly. Think about it. Now, those IDs or passwords may be encrypted at rest and encrypted in motion, but it's that split second where they get to the login screens in clear text. So the other thing that's unique about what we have is authorization consent. The owner approves what is data is shared, who gets it, and how. So in the app, in the UI that you're looking at, whether you're doing your taxes or you're doing your accounting software, your budgeting, you're presented a prompt. Do you want to share the following data elements with the following party for the following purpose for the following duration? You get then over redirect flow over to the data source, whether it be utility, a brokerage, a bank, and you're asked the same question. Hey, do you want to grant this third party access to the following data for the following purpose, for the following duration? The who, the what, the where, the when, the why, and the how. Of course, it replaces screen scraping, and we'll talk a little bit more about screen scraping. Of course, it's a RESTful API, JSON request response, which means you get faster, more reliable data, and of course, it's free to use. Remember, we're not for profit. We're not trying to make any money. We're just trying to protect the world here. And of course, we did cherry pick best-in-class concepts from NIST, things like data minimization, rule of least privilege, OAuth, OpenID, FIDO, and REST. So back to who we are. And again, the reason I pulled this back up again, I really wanted to go over, again, who's in our firm. Let me pull that back. Sorry about that. I went backward instead of forward. Short hands. So we're in Washington, and Don alluded to this earlier. What do the regulators have to say? We're all concerned about it. The CFPB went on record 3 years ago and said access to financial data records is critical. Basically, consumers own their own financial data. So that's there in the public record. Treasury said something last summer that was really important. APRs are a potentially more secure method of accessing financial account transaction data than screen scraping. Now, those of you who are technological go, duh. But the sentence before that, I wanted to call out, my legal wouldn't let me highlight it, but I want to bring it out to you, that sharing of login credentials constitute a highly risky practice. For those of you who don't know, for a regulator to use that kind of language is basically them jumping up and down and waving red flags. Some of you are laughing going, yep. So this is the money slide. I told you I wanted to arm you to have that discussion with your executive, your line of business, how to talk in business terms, why they should care. So about risk, you're eliminating held-away credentials. You have token-based access. It supports biometrics. It uses the existing authentication you already have today on the front door if you're an FI or a data source. The data elements or permission through the API are well-defined. It's no longer anything the eye can see. It's, again, we talk about data minimization, rule of least privilege. Only the data elements you need to fulfill this use case. And the tokens expire, either due to an event. So I've filed my taxes, no longer need access. I've got my mortgage, no longer need access. Or if they are ongoing, like budgeting, they expire unless renewed. So the use case of, hey, I downloaded this cool app from the App Store, I don't really like it, you delete it. Do you think that app is still not pulling your data? Well, this way it expires natively without the customers having to do anything. And that's important. We don't want the customers to have to do anything unique, special, or different. And of course, what does it mean in terms of privacy? Well, now we have clear consent at the UI and at the FI of who, what, why, and for how long. And again, it's stored in the same consent store that your online banking, your mobile banking, or any other firm has. So it's already got a mechanism for that. Everyone's very happy. The regulators are very happy with that. So is this, we always get asked on the deployment, that sounds great, Dom, but is this a whiteboard concept, or is this real? Are we really seeing it? So what use cases are really doing it here in North America, and what kind of volumes you're seeing? Who's doing it? Well, let's talk through there. So we traditionally see the customer going in through a third party, a budgeting app, a robo-advisor, tax prep, bookkeeping, and they'll go through a fintech, typically has hooks into an FI to pull the data. Under the old regime, right, the third party provider and the aggregator both have access to those credentials. Under the new regime, they don't, because you're redirected over to, and they never see credentials anywhere along the way, and if you don't hold an ID or password, you can't lose it. But it's not just those apps. If you go to a CPA firm or a financial advisor or a broker, and their office, they're going to ask for your IDs or passwords as well. Their staff's going to have that. So the risk perimeter is actually larger than you think. And of course, there's other apps out there that have that same sort of connectivity. So this is more of a visual representation of just how we got to 40 million IDs and passwords held in the wild. So who's using it? Who's got it installed? We did a poll of our members, and if you remember from the member slide, we have quite a few of the big names in North American finance. 93% have it in production, production pilot, or in active development as of January. There are over 2 million people in production as of January who have already swapped out their ID passwords for OAuth tokens, or OID Connect tokens to be more specific. That number is expected to get to 6 million by year end. We're gaining on them. We still have another 29 million to go. But remember, this is a voluntary organization. But this is real. This is happening. So one of the things I want to call out what's unique, and it was mentioned in some of the other presentations, is that this is a voluntary community. We do not have a government mandate in North America to do this. We are pulling together disparate entities in the ecosystem along that chain because it makes sense to do so, and there are legitimate business drivers to doing so. So I want to talk about why it takes a village, and then how that's reflected in our structure, how we're set up to serve that community, and of course, show that we're working with others. So CFSI is an industry group here based in DC. 2 years ago said, you know, if this is really going to work, you're going to need further coordination amongst all the stakeholders. They were the first to identify that you needed every link in the chain to participate, or you'd never see adoption. So the way we're structured, we're balanced very carefully between regulated financial institutions and non-financial institutions. Our board is chaired by an FI and a non-FI. Board committees are chaired by an FI and a non-FI. All of our working groups are chaired by an FI and a non-FI. That's important to make sure both sides felt like they had skin in the game and could steer the ship. In addition, every member in a working group has the same vote as every other member. It's very grassroots. So Don and Don App Store have an app and a garage, have the same vote as a Wells or a Citi or a Chase or a USAA. Best idea wins. In addition, ideas come from the bottom up. Remember, we're doing what our members want us to do, and they're doing what their customers are doing. You've heard the phrase, customers vote with their feet, right? And they go, if they don't like one store, they'll go to another. In this case, they're voting with their mice, one click, and they're voting with their clicks what data they're permissioning, what data is being scraped. So the volume of what's being scraped, the nature, variety, and volume is what's driving our priorities about what we put in this spec here. And it's not just here in the US, of course. Other people looked at what we've done and we've been well received. We've worked with the OpenID Foundation. So our spec, the FDX API, is actually the data specification underlying the financial grade API. Now, similarly, we've borrowed heavily from OpenID and their concepts and improvements upon OAuth for authentication in our security model. So it's a very symbiotic relationship. So that's who we are, what we're doing, and how to sell this inside your firm, why your management should care about it. So we're member-driven, but in this case, we're audience-driven. So what questions do you have for me?
Don, you promised us a bit more about screen scraping.
Sure. Those of you familiar with screen scraping, basically it started about 25 years ago, and yes, I'm showing my age. If you had an account at multiple financial institutions, the only way to get that data into one spot, that you do a unified list of your assets, was to get bank statements, key them into Lotus 123 at the time, or an earlier version of Microsoft, and it was error-prone, time-consuming, cumbersome. Someone said, you know, I can write a script to just go log in and do that. But that script needed your ID and password, and it needed it in clear text. Fast forward many years, and that's still going on in a lot of ways, because it is an efficient way of doing things. Unfortunately, in today's world of breaches and credential harvesting, it's not terribly secure at all, and there's a better way of doing that. And that's why we're doing that. But screen scraping also has some other burdens that I'll talk to you a little bit about. There's a reason, other than the security reason that Treasury mentioned, there's also a cost reason. Right now, we polled FIs and we said, you know, how many of your sessions on a given day are screen scrapers, known aggregators? This isn't harvesters, malicious people. This isn't carbon-based life forms, real humans, but actual known aggregators. And then the lowest number we got was 25%. I said, well, is that seasonal? Is that on a payday? And I said, no, that's average. So if you're Wells or Citi or Chase, I want you to think about how much money a quarter of their online banking infrastructure costs. Web servers, app servers, firewalls, database servers, and the people that need to keep that patched. You're talking tens of millions of dollars just to serve up non-human sessions. Well, an API is an order of magnitude more efficient. So if you're spending $30 million a year to serve up those sessions, it's now $3 million a year. That's a delta of $27 million a year, over year, every year. That net present value is rather strong. And there's a cost reason for doing it. In addition to the privacy benefits, in addition to the risk reduction benefits, and oh, by the way, our spec is royalty-free to use. Can't argue with that. We're going to save you money, your firm's money on the hardware side. So that's why we're so passionate about getting rid of screen scraping. So good question. I really appreciate that. Other questions, concerns? Yes, sir.
So, I don't really need a microphone, but there we go.
Yeah. Or I have to repeat the question.
When we were speaking earlier, we were talking about in the UK and Europe, the regulations require banks to open up access to regulated, authorized third parties, and they've got an automatic right of access.
Yep.
If they're authorized, with no contracts between the third party and the bank. Now, that doesn't exist at the moment in the US. So what we were talking about earlier is that the banks and the third parties will have contracts with each other, and that there's obviously some kind of benefits in that. But is that likely, do you think that's likely to remain the case, or is there likely to be a regulatory driver that follows what's happening in the UK and Europe around potentially not or requiring there to be no contracts. And my second part to that question is, how do you see, or do you see there being differences in different states in terms of how the regulations might mandate or regulate which types of organizations can trade in this ecosystem?
All right, and the answer to the first question is see none of the above. It's not a binary between, oh, there's, it's all current common manual contracts or the government has to do it. Right now, yes, if you, in North America, if you want to hit somebody's data source and pull data across, you go through their sourcing department, like every other third party or vendor that they ship data to, okay? It's the same process. It's onerous, it's expensive. But rather than saying the government mandating and vetting folks, there's a third way, and that is the industry is looking at some common solutions, not unlike with PCI DSS. The government isn't mandating it, the industry did, and they said, okay, here's a half dozen firms that can get you your PCI DSS audit. Therefore, go forth and come back with your certificate. So there have been some industry groups looking at a common bilateral agreement, common audit frameworks, common audit standards, to try to do it one and done, so that one firm, once they're blessed, don't have to resource with each FI, because there are over 13,000 FIs just in the US, and no one wants to go through 13,000 audits. So I really believe the industry will fix that. We've seen other instances of them addressing that kind of risk privately through insurance, through joint trade associations. Now, with your second question with respect to regional variation, we do see some of that. For example, when I mentioned 401k, that's great, but that's unique to the IRS tax code here in the US. In Canada, it's an RISP, a Retirement Investment Savings Program, I believe. So it's different. It's still, the dollar amounts are the same, the purpose is the same, just what you call it's different. So that can really be reflected in differences or additions to your data dictionary. In a lot of cases, it's the same thing. In the UK, they call them current accounts, we call them checking accounts here. The nomenclature is the same, but it's just one more entry into a metadata dictionary in a lot of cases. But to the extent that we would extend it for regional variation, absolutely, it's not untenable. So we have fields for currency, you could just say pound instead of dollar. I think the spec is robust enough to handle that already. Again, we're already in use in the UK, so I don't see any reason why it wouldn't be, and it would be not very hard to extend it for any regional variations for something really off the rails. But what's neat about it, and we're pretty robust now in that we already have checking, savings, CD, IRA, 401k, pension, auto loans, home loans, HELOCs, HELINEs, investment accounts, margin accounts, defined today already. Why? Because that's what consumers are scraping, and we're following the clicks, basically. And that's why we have such a broad and deep data set. But thank you. Good question. Yes, sir. Al? Sorry. Dad was a Marine. Yes, sir.
So is there any chance that there will be, I haven't read the spec closely, but is there a chance you can also incorporate some privacy GDPR, similar GDPR queries that would kind of layer in addition to these things?
There's no reason we couldn't. We're a member-driven organization, and we'll put anything in there that our members want and that we ratify. But to the extent that we do answer privacy questions, and I do want to go back, the consent that we gather, let me go back to the risk slide. Again, we're capturing at the UI and at the data source, and it's more than just FIs. We've been approached by a couple of utilities. Turns out electric companies are scraped too. We're capturing the who, the what, the why, the purpose, and for the duration in clear and concise language already today, which goes a long way to making CCPA and PSD2 privacy language happy, if you will. But to the extent that we have any gaps, we'd certainly be open to adding them. There's no reason not to.
Yeah, I was thinking more like in the sense that many of them will resell data. Financial institutions have a clause in there about reselling data.
Yep.
It'd be nice to know if you could. It's not a hard thing to put in an API.
Sure, but remember, we've already talked about the purpose. Remember, the purpose is budgeting, robo-investing,
so
tax
kind of
prep,
out of scope then.
not for resale. Now, if they want to disclose that, hey, this app is not free, there's in-app purchases, Candy Crush, okay, that's their business. But as far as the data itself, what you're permissioning, those are the minimums, the who, the what, the purpose, and the duration.
Hey, thanks.
Sure. Yes, sir. Oh, yeah. No worries. Well done.
Thanks. Nick
Sure.
Mothershaw from Experian in the UK. So we're at AISP in the UK, and on the topic of consent. So
Yes.
With GDPR, which we're subject to, we have to be very explicit about the consent in terms of your who, what, why, how long in each different use case. In the US, how explicit would that need to be? Could it be more generic in general T's and C's that are associated with the site that match the purposes of the site that's extracting the data?
Good question, and I'm really glad you brought that up. We've actually spent a lot of time and money doing actual focus group testing and UX development, actually weeks and weeks and dozens of sessions, actually asking real carbon-based life forms how they view this consent, both at the FI, or both the app level and at the FI. And we've had some interesting findings. For example, in digital banking, they keep telling you less clicks is better, fewer screens is better. And yet the model that had the consent at the app level and at the FI tested much higher because they like the reconciliation, the agreement, if you will, in the session that, yes, both sides agree on what's being passed. Who knew? So we're actually going to be publishing user experience guidelines as far as common nomenclature, common presentment for small screen, mid screen, and large screen in, what's the one, adjustable format, responsive design? Thank you. See, I have so much better tech people in the audience than up here. Thank God. So we're doing that, and we wanted to come up with common language because, as we saw in the UK and other places, there's way too much variation what's disclosed. Now, we still have a little carrot that expands that makes our regulatory friends happy, and that 1 in 100 customer that actually reads that stuff. So we have the best of both worlds. We've been showing that around to CFPB, Treasury, OCC, NCLC, and some of the other groups around here in DC, and they're very comfortable with it. They like the idea that it's in kitchen English, that it would be common, certain common concepts, and we're not keeping the data to ourselves. We're actually going to publish our findings and the UX guidelines on our website probably in about a month or two, because we want the world to adopt it. We worked hard on it. We're kind of proud of it.
Just another one related to that question. So I think it proves that the Brits and the Americans are quite similar because we did the same research, and actually that's what we originally in the UK, the model was that we displayed consent to the customer at the third-party side and were reasonably explicit, and then when the customer was redirected and they authenticate, we had the model that they were shown the kind of same thing again to confirm. And we were told by the regulators to take it out. The regulators said, well, you have to take that out because you can't replay consent on the bank side of things. So we've kind of got to a bit of a compromise in the UK. So what you can do is if the customer, once they're redirected, you can't show the customer that granular consent, but you can allow the customer to discover it. So it's a bit of a compromise. But I mean, that was not because the customers didn't want it, because we had the same findings, but it was because the regulators said you can't replay that because it might distract or put the customer off. But the one point I wanted to ask is, one thing that we found is that the purpose for the consent is something that, on balance, we've kind of left that on the third-party side, because there are a number of use cases where the bank, in this case, shouldn't know why the customer's asking for the data. So the purpose shouldn't be made visible to the bank. For example, if a customer's asking for data for purposes of getting a loan, they might not want the bank to know because they're going to get a loan with someone else and they might be oversold from their bank. So the actual purpose is something that we deliberately haven't put in the model. Probably the bank could guess, but.
There's a couple reasons for including that. One, it's further transparency into why the request is being made. From a security standpoint, it also allows us to limit token scopes. For example, a tax preparation token has no business asking for cell phone number, email address, tax ID. Well, tax ID, yes, but certain data elements. So it allows you to say, well, wait a minute. God forbid there's ever something gone awry at a third party, and so you get a malformed request or something weird coming across. You can say, whoa, hold on. You're not permissioned to ask for that. So that's one part of it. And the other one is, in a very competitive market with 13,000 FIs, it really isn't a concern about, oh, so you're shopping this mortgage around. I had better up my game and offer you a better rate, better term. and it seemed to be more pro-competitive. There's nothing punitive. We're not going to call, a bank's not going to call somebody's loan or close a loan because they're shopping their credit card or shopping their mortgage around. Instead, it's like, holy crap, I'm going to lose this customer. What can we do for you? And so it's deemed more pro-competitive. So we've got about 30 seconds. Any other questions? Yes, sir. Yeah. Absolutely, we do. Let me go back. Go forward through the deck. We're getting there. So yes, marketing and PR, who we are. Hey, we exist. Government affairs to keep our friends, the regulators, informed. Corporate communications, so our own firms are informed. Qualification and certification, doing a lot of the same things that we talked about earlier. The data spec, the security and authentication, user experience, I've harped on and bragged on already. And of course, we have a very tight relationship with OFX, with the grandfather of all this space. I expect some big news coming very soon with OFX and FDX. Stay tuned, that's all I can say right now. So cool. Thank you for your time.